Hello and welcome to our Academy Accounts Workshop Part 2. I'm Hugh Swainson, I'm a partner within Buzzacott's charity and not-for-profit team. And with me today I've got David Wallace and Catherine Biscoe, who also work in the same team, who will talk us through the webinar today. So on to the agenda on the next slide. Last week we had the Academy Accounts Workshop Part 1, which talked you through the Coketown Model Academy accounts and some of the technical points around the preparation of those accounts. Today we're going to look at a much more practical workshop looking at the process of preparing your year-end financial statements and looking at the sort of things that you need to think about for the audit. So I'm going to start off by looking at some of the aspects of accounts preparation, what you need to do to prepare your year-end, the kind of key areas and journals that you might need to prepare. David Wallace is going to have a look at the actual process of taking your reconciled trial balance and turning that into a set of Academy Trust accounts. And then Catherine Biscoe is going to look at some of the audit aspects and key things you need to think about for preparing for the audit. So before we begin, just a bit of virtual housekeeping. As a webinar, your microphones will be automatically muted and your cameras turned off, but there is a Q&A panel on the right of your screen, so if you've got any questions throughout the webinar, please do ask them and type them into the Q&A. If we have time at the end of the webinar, we'll answer questions then. They'll all be done anonymously, but any others will follow up with an email after the event. The webinar is being recorded, so after the event we'll send around the recording and the slide deck. So let's move into the first section. So if we go to the next slide and looking at preparing the year-end accounts. So ultimately the objective is to prepare a set of financial statements that's compliant with the ESFA's accounts direction. So I'm going to first look at some of the steps that are needed in order to produce that. The first bits are relatively obvious. Obviously, you'll need all of your transactions onto the accounting system and get your reconciliations all completed and that trial balance fully reconciled for the year end. But I'll be looking at some of those key areas to think about when doing those reconciliations and preparing that information. Then you've got to take that trial balance and turn that into your statutory set of accounts. So that process of mapping that trial balance into an ESFA format, David Wallace will look at later on, and then once you've got all of that and you've got your mapped trial balance, there will be further information that you need to provide for the accounts that doesn't come straight from the trial balance, and further information that you need for the audit. So we'll have a look at some of those areas too. Don't forget, you'll also need to prepare the Trustees report and the governance statement, so the front end of the accounts. That was covered in part 1 of the workshop, and we're not planning on going through that in any great detail today, but obviously that needs to factor into the timetables and deciding who's going to draft each of those elements. One key point to mention around the preparation of the accounts, some Academy trusts will prepare their accounts in-house, some will do it with support of their auditors. You may remember that the revised ethical standard 2019 came in a couple of years ago, and one of the impacts of that was that external audit and internal audit couldn't be done by the same firm, but there were other implications as well for things like accounts preparation. And so whenever we support Academy trusts with preparing accounts, we do it via separate teams, so it's separate people helping you prepare the accounts to those who are checking and auditing them. And it's really important that if you are getting that support with the preparation of the accounts, that you're still owning those figures and reviewing those before they're handed over to the audit team for their scrutiny. So over on the next slide, looking at that year-end preparation. Now, given the current requirements in the Academy Trust Handbook, Academy Trust will be doing a lot of the balance sheet information on a monthly basis in any case, so all of the key reconciliations of bank, VAT, etc. will be happening throughout the year. But there may be certain things that aren't done in such detail throughout the year, like the accruals and prepayments, the reconciliation of some of the fund accounts, the fixed asset accounting, and certainly the local government pension scheme accounting that happens just once a year. So it's important to factor in all that extra work that's got to happen for preparing the year end that doesn't need to be done on that monthly basis. There'll also be further analysis of things like staffing disclosures and information for the academy accounts return, which isn't needed throughout the year and is extra process for the year end. So an important part of preparing for the year end is identifying all of those requirements that need to be prepared and getting that all timetabled in. So on the next slide, what I wanted to flag up was some of the key issues that we commonly see for academy accounts preparations that need careful preparation. The first area is fixed assets. Firstly, making sure that your fixed asset register is up to date, reconciled, and it reconciles back to your accounting ledgers. And one of the key considerations when coming to the year end is that often academy trusts will do capital work over the summer, because that's the time when the school's quiet and you're able to get in and do that capital work, which means there's often a lot to think about around cut-off at the year end. Ultimately, you need to make sure that all of the work that's been done up to 31st of August is captured in the accounts, even if the invoices come in later and you need to accrue it. So if you have got a lot of capital work going on over the year end, really helpful to get a year end statement from the contractor to say where the work is up to. Otherwise, you're in the territory of trying to accrue parts of invoices if they give you an invoice for work that covers either side of the year end. Another key aspect of this is sort of decisions around whether items are capital or revenue or in nature. Because academy trusts often have a number of buildings, but often that's all on their balance sheet as a single figure in their fixed asset register, perhaps because they base the building value on an ESFA valuation. It's difficult to sort of break down into components. So when you get a new bit of work, say a roof or windows, it's whether you're treating that as a maintaining the existing building or a new capital item. Clearly, anything that's a new structure or an extension to a building should be capitalized in the financial statements, but there may be areas that start getting into more of a grey area to consider as to whether that goes to expenditure in the year or becomes capitalized. But we're seeing an emphasis these days in accounting standards in a component accounting, which encourages you to capitalize separately components such as roofs and when those capital projects go through, and then consider the depreciation period. Should it be the same as the whole building, or does it require a separate depreciation period? So those decisions are really important to plan out, and may well be worth discussing with the auditor and the audit team prior to posting the journals to the accounting system, so everything's sort of agreed up front on those key treatments. Fund accounting is probably the biggest area that can be challenging for the year-end accounts, so I've got a separate slide in a second to go through all of that. The year-end pension journal, this is for the local government pension scheme, where there are pages and pages of disclosures in the academy trust accounts to explain that pension liability and the assumptions behind it. As that's quite a detailed area, I'm not going to go through it now, but we have provided within the pack for today a separate working of that pension journal. So if you have your actuaries report and want to prepare that journal yourselves, there's a working on how that's constructed on there that takes you through it. And the final point here is just a reminder on opening balances. It is really crucial to get a check to make sure the opening balances on your accounting system tie up to last year's signed accounts, taking account of any journals that might have happened on the way to producing that year-end set of accounts in the prior year. So please do make sure that check is factored into the process on the opening balances. So over onto my next slide and looking at fund accounting. So what you can see in front of you here is the funds note within the Coketown model accounts. And the way this is constructed, the columns just take you from the opening balance at the start of the year to the closing balance at the end of the year, taking into account the income and expenditure during the year. And the rows take account of each type of restricted fund, and they're split into groups. You've got the restricted general funds, which are all the sort of revenue funds, the GAG, all of that. You've got the restricted fixed asset funds, which is just specifically for fixed assets and the different classes of those. And then you've got the second row up from the bottom, your unrestricted funds. So an important part of the accounts preparation is how do you construct this note, because it won't all map naturally from the trial balance. The first column's easy, the balance at the 1st of September 2021, because you have that from your last year's signed set of accounts. The income should also be relatively straightforward, because most academies will, in their chart of accounts, separate off the GAG and the pupil premium, etc., so that this can easily be mapped into this note to the accounts. The expenditure is where things start getting more complicated, because within your accounting system, virtually all academies won't have separate details of costs by fund. So, for example, when you do your payroll journal, you have your staff members. You won't have a staff member that's specifically a GAG staff member or a pupil premium or an unrestricted fund staff member. So there's got to be some assumptions made at the year end on how to allocate costs to the different funds. So what's the normal way of doing this? The way most people will do this is starting to look at those individual restricted funds and what the balances they're carrying forward on those. So if you took, for an example, the pupil premium fund, you are required to track your pupil premium fund expenditure and report that on your website, whether you've spent it. So you should know coming to the year end whether you're carrying forward a nil balance, as you can see on Coketown here on pupil premium, or whether there's a balance you're carrying forward. So that in turn enables you to allocate the expenditure there, and you should be able to work through most of the restricted funds on a similar basis. When it comes to unrestricted funds, it's important to consider whether any of the unrestricted activity has direct costs associated with it. So if you have, for example, lettings income coming into your unrestricted funds, are there direct costs of this that need to go into your unrestricted fund expenditure, because it would be unfair to try and allocate that to GAG funds or another restricted fund pot. So make sure you've tried to capture all those direct costs in particular that relate to the unrestricted funds. As a result of all of that, you can then ultimately determine what the GAG expenditure is, but that's effectively the remaining amount once you've allocated all of the other areas. The next point to look at is the capital funds, the restricted fixed asset funds in the middle of the page there. You'll note that this has a number of rows to it, and what this is trying to say is that you'll have various fixed assets at the academy, but they will be funded by a number of different sources of income, and academy trusts are required to track which source of income their assets are funded by. So you can see here some of them are transferred on conversion, some have come from capital expenditure, from GAG, etc. So in theory, the balances that you've got are represented by fixed assets, and the only way to really track that effectively is if your fixed asset register has details of which fund the asset was came out of. So therefore you'll be able to filter your fixed asset register by the funding category, and then come up with the the relevant depreciation charges for those assets and the balance carried forward. One key thing about this restricted fixed asset fund is how it relates to the net book value of tangible fixed assets. Often the restricted fixed asset fund value will be the same as the net book value of tangible fixed assets, but it can be that you have unspent capital money at the year end. So you've received some SIF money, for example, just before the year end, or you've got some SCA money left over, which is ring-fenced capital money, but hasn't been spent yet, and that needs to sit within your capital fund, because it would be unfair if that's set in the revenue funds, because you'd be over reporting the amount of revenue funds you had available. So it's important that as part of preparing this note, you're clear on the amount of unspent capital money that you have at the year end left over, and therefore you can compare the value on the fixed asset fund, being the value of fixed assets plus any unspent capital money, with the value of fixed assets on the top half of the balance sheet. The depreciation charges are normally the expenditure item going through within the expenditure column on the fixed asset fund. The other key area is the transfers between funds. So you see the column, the second from last column of gains, losses and transfers. This is mixing two things. Gains and losses is about the gains or losses on your pension reserve. So you see the total of the column, the 319, is just that movement on the pension reserve row there. The other transfers will always come to zero. So in this scenario, there's only one transfer because the Academy Trust has purchased £10,000 of tangible fixed assets out of its GAG fund, so it needs to make a transfer from GAG to the fixed asset fund to represent that. Again, shows the importance of being clear where all of your additions in the year were funded by, and making sure those appropriate fund transfers get transferred across to resolve those numbers. So that's a really key note to the accounts. It's probably the one we most commonly see challenges with throughout the audit process, so an important one to focus on up front. Just going over to my next slide. The funds notes will also give details, if you're a multi-academy trust, of the breakdown of the funds by school. So some academy trusts will formally pool their reserves. They won't need to break it down by school, but unless you formally pool your reserves, you'll have to give details of funds by school. And because in this note the pension reserve and the fixed asset fund is split off, this is just genuinely the revenue reserves by school. So this should tie up with your year-end management accounts, subject to any late journals that have gone through as part of the accounts preparation. So these should be meaningful figures for how much funds each academy is holding. The numbers don't easily come off trial balances when mapping the accounts. It's really important as part of the accounts preparation process to review this note to the account and make sure this makes sense in terms of your year-end management accounts and how much the level of funds are that you expect to be holding at each school. Over on the next slide, just looking at some of the financial statements disclosures. Whilst the vast majority of information in the financial statements will come from your trial balance, there are certain items that won't, and we've listed some of those out here. The list is not exhaustive, but it highlights the need for things like if you've got operating lease commitments, those commitment disclosures are not going to come off the trial balance. There needs to be schedules and workings done to produce that note to the accounts just as part of the year-end process. So all of these items are really important to sort of plan out and make sure that you've got the information ready for the accounts preparation if any of these items do apply to you. The biggest area of this on the next slide is the staff costs disclosures. So there's a huge amount of disclosure required for academy trusts around pay and remuneration, details provided in part 1 of the workshop, and that all has to be pulled together at the year end. So things like staff numbers can take time to pull together, especially if you're operating as a multi-academy trust and you've got to pull numbers across from a whole variety of schools. Ditto with the higher paid remuneration and banding, trying to collate that information from across the trust. So really important to allocate time to pull together all of these disclosures. And on the next slide, it's worth a reminder that even though you have disclosures in one way for the financial statements, you also have disclosures around pay and remuneration for the annual accounts return, the AAR, and they'll be done from the same data, but they'll all be presented in a slightly different way. So you end up with full-time equivalent staff numbers instead of average staff numbers. You split by gender, those kind of information that's needed for the AAR. So it's probably worth doing that at the same time. If you're going through all the payroll information at one point for the preparation of the accounts, it's probably worth pulling all of that data together at the same time for the AAR. The AAR guidance isn't out as of today, so that normally gets issued later on. We're not hearing of any significant changes to it, so you're probably relatively safe to go ahead and prepare it on the same basis as last year when you're preparing for the year end. There is other information as well that's needed for the AAR around benchmarking information, counterparty balances, etc. And I just highlight that benchmarking information's particularly important one to check these days, because that data from the benchmarking return within the AAR does get pulled into some of the ESFA's wider benchmarking information that's on public record. And so if it's not representing the sort of analysis, it's only so good as the data that goes into it. So if the analysis isn't quite as you want it, then that may not be coming through on sort of public record as you wanted as well. So extra focus on the benchmarking return these days is particularly important. So that's an introduction to preparing the accounts, but I'm now going to hand over to David to talk you through the actual process of taking the trial balance and turning that into a set of financial statements.
Thanks, Hugh. Good morning, everyone. So I'm going to be spending a bit of time talking through our Excel Academy accounts template. So this is the tool that we offer to our Academy Trust clients to help take your closing trial balance and convert it into a set of statutory financial statements which are compliant with the ESFA accounts direction disclosure requirements. It may be that you'll be asking Buzzacott to help with the preparation of your statutory accounts, but if you are, we hope this part of the session will still be useful for you, as we hope it will help you to understand the process by which your accounts have been prepared. We will always ask you to review the numbers after we've prepared them, and hopefully this session will help provide better context of how we would typically complete our work. So on the first slide, we've set out some of the key benefits of using our template. And there are actually multiple templates that we have available, including ones that can be used by single Academy trusts, ones for multi-Academy trusts, and even those for Academy trusts with subsidiaries where a group consolidation is required. And there are two key reasons for using these templates. Firstly, the Excel workbook helps provide an audit trail between your trial balance and your final accounts. It's typical for most of our Academy trusts that we work with for the numbers ultimately to end up in a Microsoft Word document, which contains both the narrative reports, including the Trustees report and the governance statement, as well as the numbers. But actually, if you were to look at the Microsoft Word document in isolation, it can become tricky to understand the makeup of the numbers and how they've been derived. So as you will hopefully see as we work our way through the session, this workbook will allow you to trace the majority of the numbers back to your source trial balance. Secondly, it will help you produce a compliant set of accounts that meets the ESFA's disclosure requirements. We update all our Excel templates every year to take account of the latest ESFA accounts direction and any new disclosure requirements. So using these templates should offer you a good level of confidence that disclosure requirements have been considered in full. To reflect the 21-22 version of the accounts direction, for example, which is the latest, the SOFA and the notes throughout the template have been updated to reflect the required revised presentation of Teaching Hub income and expenditure, for example. Even if you've decided not to use our template or you have your own pro forma for compiling the statutory accounts, you may still find it beneficial to refer to our template to see how we've approached the workings behind some of the ESFA disclosures. There are some other templates, other benefits to using these templates as well. There are built-in validation and integrity checks throughout the workbooks, which will help alert you to potential errors in data entry or where numbers which should match in different parts of the accounts aren't quite matching. And we'll see how these appear on a later slide. There may also be the need for adjustments to the figures after the accounts preparation work or the audit work begins. These can be incorporated by feeding through the relevant journal adjustments from a worksheet within the Excel workbook that contains a log of all such adjustments. And this again helps to keep a clear trail of how the numbers have been derived, and we'll see how this works again on a later slide. Finally, it also provides a simple way of aggregating the individual trial balances for multiple schools within a MAT. So moving to my next slide, we can begin by seeing what the workbook actually looks like. So on the right hand side of the slide in front of you, you will see the SOFA tab, which looks almost exactly like the SOFA that you will see within the Coketown model accounts. The key difference being that our template has particular cells shaded in different colours, and these colours are quite important. The same cell colouring arrangement is used throughout the workbook, and to the left of the slide, we provided a key explaining what each of these colours represents. The green cells are user field cells, which means that the relevant figures will need to be hard typed by the user directly. What you will hopefully observe as you use the workbook is that we've tried to minimise the use of green cells as much as possible. The whole purpose of the workbook is to allow you to easily track numbers back to your trial balance, so it makes sense to limit the number of hard typed figures. The green cells are mainly used in areas such as staff cost disclosures, where the analysis will not be available from a trial balance, or for example, comparative information where the audit trail already exists in the form of last year's signed account, so there's no need to remap last year's TB. On the other extreme, the blue coloured cells are those which contain a pre-filled formula, which will try and grab data from another location within the workbook, ultimately flowing the link all the way back to your trial balance. There's also a middle category, so the purple coloured cells, and these require the preparer to give a bit more thought as to the best way of pulling the data into that cell, but ideally linking back by formulae wherever possible. So this is typically going to be relevant in relation to fund accounting decisions. As an example, you may have a nominal account on your trial balance which is used to record your donations income, but some of that income may be restricted and some of it may be unrestricted. By default, the template will assume that all of the general donations are unrestricted, but if this is not appropriate, you may need to adjust the formula in a neighbouring purple cell to show the correct analysis. So how is it that the numbers are populated and where did the figures in the blue cells come from? If we move on to the next slide, we will see the main tab within the workbook, which will drive where the numbers are spat out into in the relevant areas of the accounts. It's the trial balance tab. The screenshot on the right of the slide shows an extract of a trial balance tab that's been partially completed. The green cells are where your raw trial balance data is originally entered, so that's columns C, D and E. And this can literally be copied and pasted through from an Excel export of the trial balance taken from your accounting system. The key role for the preparer is to complete column B, the type column. This is what will determine where the number feeds through to within the rest of the workbook. For the template to work, you can only use the type that is available from a predetermined listing. So there's a tab within the template workbook called Key for TB codes, which contains a full list of the available types. An extract of that tab is shown at the bottom left of the slide. So as an example, if we take prepayments, you would check the Key for TB codes tab to find the most relevant type, which in this instance are the letters P, R, E or pre. If you successfully entered a type which is included in our predetermined list, column A of the trial balance tab will automatically update to say yes, the type is valid. If you've made up your own letters or entered the type incorrectly, column A will indicate the type entered is not valid by returning the response no. If your accounts are not balancing, then one of the first checks that you can do is filter column A for any no answers to check if there's been a typo in entering any of the data in this column. You may at this stage be wondering why column B is coloured blue and not green. Well, for those of you who have used our template in previous years and do not wish to have to go through the effort of reassigning the type for every single nominal account again, there's a facility within the workbook to help automatically populate this column by copying and pasting last year's map trial balance into the prior year tab or the PYTV tab. There are full instructions for everything that I'm going through, including the prior year TV point within a guidance tab on our workbook. So I won't go into further detail on that now. But continuing with our example of prepayments, if you can take a mental note that the balance on the prepayments nominal account on this trial balance is a 39k debit balance. We'll now move on to the next slide and see how this gets pulled through into the accounts. So on the bottom of this slide, you will see an extract of the debtors disclosure note, and you should see that at cell J71, the prepayments and accrued income line has correctly returned 39k as the prepayments balance. Now, if you look at the Excel formula bar on the same screenshot for cell J71, you'll hopefully see how the type mapping is being used by the formula to return the correct value. So this Excel formula is used throughout the template and is simply asking Excel to add up all the figures on the trial balance with the relevant type name used at the end of the formula. For the preparer's convenience, at column R, we've also noted the type that is being searched for in the formula for the blue cell in that row. We've noted it there to save you having to look at the formula in each cell if for any reason you're trying to troubleshoot. On the next slide, I mentioned earlier that there may be a need to make further adjustments to the numbers after work on the accounts preparation or the audit has begun. So any such adjustments should be recorded in either the Accounts Journals tab or the Audit Journals tab, depending on whether the adjustment was identified during the accounts preparation phase or during the audit phase. So for example, say we determined during the audit that the purchase of some new furniture for the Academy Trust costing 5k had been incorrectly added to the prepayments balance. You can see on the top right screenshot the details of the necessary correcting journal which needs to be made. Now, so long as the nominal code is correctly entered within column C of the Journals tab, The formula included within the journals column of the trial balance tab, i.e. column F on the bottom right screenshot, this will automatically populate the necessary journal and adjust the final value to be used in the accounts. Whilst this process is automated to a large degree, please do be careful, as any typo or transposition error made in the nominal code column of the journals tab could mean that the adjustment is made to the incorrect trial balance line or not adjusted for at all. On the next slide, we look at the funds disclosure note again. So as Hugh's previously highlighted, this is a crucial disclosure note within the accounts. Unfortunately, this workbook or any other workbook or software will not be able to miraculously produce a set of financial statements which is 100% compliant on an automated basis. And one of the key reasons for this is the fund accounting. It's very unlikely that the way your accounting software exports the results for the year to a trial balance will provide the full analysis needed to be able to easily map the movements on individual restricted and unrestricted funds during the year. So a more careful review of the disclosure will be needed by the preparer here. Our template is set up to make certain presumptions regarding the funds movements. These presumptions may not be accurate or appropriate for your circumstances. So on the screenshot on the right, the first two columns should be pretty straightforward, and the balance brought forward is a green cell and will be hard typed from last year's accounts. And the income should generally be mapped out okay, depending on how detailed your chart of accounts is. It's really the expenditure column where a bit more attention is needed. As an example, the template is set up to make the assumption that the pupil premium income or other grant income will have been fully expended in the year of receipt. This may not be appropriate for your Academy Trust, in which case the formula in the expenditure column should be amended. Similarly, there are typically various rows within the restricted fixed asset fund section of this disclosure, depending on how your tangible fixed assets have been financed. But the trial balance will likely only show the total depreciation cost for the year by the class of fixed asset rather than funding source. So you'll therefore need to determine the best way of allocating the depreciation charge for the year between the relevant rows in the restricted fixed asset fund section, which in this example for the screenshot are rows 38 to 41. So on the next slide, as you mentioned, for multi-academy trusts, there is a requirement to disclose the revenue reserves balance by individual school. Again, the template will try and calculate this based on the figures in the individual school trial balances for income and expenditure. But again, the way the balance has been calculated may not be the most appropriate. So this should be therefore be checked against your own expectations and internal reports, and the formulae adjusted as needed. On my final slide, there are just a few additional pointers. Firstly, as I say, there is a guidance notes tab included on the workbook. Please do read this before you start the work, as it will provide a good refresher on the steps needed to compile your accounts. It may be that after you've completed the steps, you find that your accounts do not balance. If it looks to just be a rounding difference, our recommendation would be to check the final numbers column on the trial balance tab. The workbook will round off your TV figures to either pounds or thousands of pounds. If your trial balance is not letting down exactly to zero, then this has probably risen because of the rounding process, in which case just adjust one of the largest figures on the final column by adding or minusing a 1 or 2 to clear the difference. It may be that the imbalance is not because of rounding, but because some of the TV codes haven't been pulled through to the accounts properly. So there are 3 things that you can do here to try and zero in on the cause of the imbalance. Firstly, I mentioned earlier about double checking the very first column on the trial balance tab to check whether all of the types used were valid. Do check that all of the type codes you used are within our predetermined list. Secondly, on the right-hand side of the trial balance tab, you will also see another set of filtered columns that show exactly which disclosure note the figures will have been taken to. You can also use these filters to help locate potential errors. And finally, you will notice throughout the accounts template, there are validation boxes included to the right-hand side of the actual accounts pro forma. So you can see an example on this on the screenshot on the right-hand side of the slide in front of you. These boxes should light up to alert you if there is an issue with the data pulled through on a particular row. So again, addressing these items first should help you to identify the cause of the imbalance more efficiently. Please do make changes to the templates to meet your own disclosure needs. We've modelled ours on the Coketown model accounts, but we know that some of our academies like to include additional analysis over and above what is included in Coketown. But where you do this, please do try and use the same sort of formulae and principles as for the rest of the template. The more you start adding in hard type figures, the more difficult it becomes to see the audit trail. Finally, there is an accounts return tab also included within the template. For the avoidance of doubt, this template is not going to populate the entire accounts return for you, but the tab is there to calculate the additional information which will be needed eventually to complete the accounts return. So if this is completed at the same time as the accounts, then we'll already have a lot of the information that we'll need at a later stage. And I think that's everything from me on the Excel workbook. So I'll now hand over to Catherine, who will discuss some of the audit preparation requirements.
Thank you very much, David. So yes, in my section, I'm going to go through the audit requirements for Academy Trusts and go through some of the things that you can do to help you prepare for the year-end audit. So if we start off with the first slide, this is really just setting out the various audit requirements for Academy Trusts. So as you'll be aware, there's the financial statements audit opinion. And here really what the auditor's looking at is to be able to state whether the accounts present a true and fair view. So that's looking at the financial performance of the Academy Trust in the year and its financial position at the year end. The auditor will also be looking at whether the accounts have been prepared in accordance with UK GAAP. So this means the underlying financial reporting framework, which in your case is FRS 102 and the Charity SORP, and also the relevant legislation. So again, in this case, the Companies Act. We also need to be looking at compliance with the ESFA Academies Accounts Direction and the Coketown model accounts. And this will have been covered in detail in part 1 of this webinar last week, if you were able to attend that. And then finally, whether the information in the trustees report, the governance statement, whether that's consistent with the financial statements and also with the auditor's understanding of the activities of the trust. So that's all within the scope of the financial statements audit. There's then also a limited assurance conclusion on the statement of regularity, propriety and compliance that is made by the accounting officer and included in your financial statements. And then also, as we've been hearing, there's the AAR return. And again, the auditor will need to produce a limited assurance conclusion to the SFA on the compilation and the contents of that return. So 3 core sort of audit requirements there. If we move on to the next slide, we look at the financial statements audit in the first instance. So really this was the true and fair opinion point. So in order for the auditor to be able to reach that opinion on the figures in the accounts, they need to look into these figures in detail. This work is all documented in an audit file, and this is really essentially just a sort of a directory, I suppose you could think about it like that, for the key financial statements areas. So if we look at sort of tangible fixed assets as an example, the auditor would really want to be looking at where those numbers come from. So they would have to agree the figures in the notes to the accounts through to your accounting system. And obviously we were hearing about our workbook before. That might be one way of doing it. You may have your own templates. We'd also want to be looking through to the underlying documentation such as the fixed asset register and checking that as well. For significant balances within that figure, we'd want to be doing analytical work. We'd need to understand the reason for any variances from budgets or expectations. We'd also probably be doing some element of sort of detailed testing or vouching to sort of supporting invoices, contractors, reports, other documentation. As part of the audit is always going to be the sort of the riskier areas that we're focusing on. So in this example, there might be some capital work ongoing at the school over the summer holidays. And again, Hugh mentioned this when he was talking about the accounts preparation side. But from the audit perspective, of risk here will be around cutoff. So the auditor will be looking at those sort of invoices received after the year end, and making sure that these have been accrued where appropriate. That capital commitment disclosures are correct and so on. And then we would do a sort of a similar exercise for the various different areas within the financial statements. If we move on to the next slide, what I've set out here is really the practical information, I suppose, that you would need to pull together in advance of the audit fieldwork. And this will ensure that you're prepared. It will help the process run smoothly and mean that you're sort of best placed to answer any questions from the auditors. So that would include things like schedules that agree through to the trial balance, Obviously, if you're using the workbook, that will be able to sort of enable that for you. Year-end balance sheet reconciliations, as Hugh was talking about, balance sheet breakdowns for things like prepayments, accruals, age debtors, age creditors, and then all of the additional sort of schedules that support those additional disclosures that don't come directly from the TB. So again, things like the staff numbers, the severance pay disclosures, and you will have heard last week about the additional sort of disclosure requirements here. So you may have to find some additional information compared to prior years. Higher paid employee disclosures, again, all of that, if you have that ready in advance, makes the audit a smoother process. As well as the information that supports the figures in the accounts, the auditors will also be looking at things like minutes of board and key committee meetings. They'll be looking for declaration of interest from your trustees, your senior management team. They'll want to look at budgets, forecasts, and so on. And what auditors would normally do is collate all of this in a sort of prepared by client or deliverables list, which they will share with you at the planning stage to make sure that you're sort of ready and can prepare for the year end. So if we move on to my next slide, I've sort of just got on the screenshot here an extract of the prepared by client list that we use at Buzzacott for our clients, and we have also shared the full version of this as part of the pre-webinar resources. So you should have a full set of that to have a look through. But as you can see from the extract on the slide that we have here, for debtors, cash at bank, non-payroll expenditure, it really just gives you a bit of an idea of the type of supporting documentation that you would need to provide. But hopefully, in most cases, this is what you would be pulling together anyway as part of your year end and putting your accounts together. If we move on now to my next slide, we're looking at regularity now. So on this slide, we're really just looking at the key sort of definitions for this assurance engagement. So regularity refers to the funds having been spent in accordance with the purposes intended by Parliament. Propriety is about standards of conduct, behaviour, the corporate governance at the Academy Trust. And then compliance is about operating within the terms of your funding agreement. And this does include the relevant Academies Trust Handbook, which is why it's so important. If we move on to the next slide, here I've just set out some of the sort of most common issues that we see arising from regularity audits across the sector. Things that you might expect, I suppose, things like related party transactions not at cost, severance payments for which prior approval hasn't been sought from the SFA, having entered into finance, leases, or also things like actual fraud or theft that's happened at the Academy Trust. You may also have audit recommendations arising from the regularity audit where maybe your financial procedures are out of date or your financial procedures are not actually in line with what happens in actual practice at the trust, or where maybe approval of relevant transactions isn't in line with the Academy Trust Handbook. On my next slide, really just looking at upcoming regularity audits. So in 2022 audits, the Academy's Trust Handbook, which is relevant, is the 2021 Handbook, which was issued last summer and became effective from 1st of September 2021. So as you will be aware, the ESFA rebranded the Academy's Financial Handbook under the heading of Academy Trust Handbook last year. And this change was really to sort of recognise that the responsibilities of trusts that were set out in the handbook now really extended beyond the sort of simple financial controls and included wider aspects such as governance, safeguarding, health and safety, estates management, and so on. As we saw earlier, under the sort of compliance requirement, the requirement is to comply with the handbook. So by virtue of having to comply with your funding agreement. So it is important that every year you ensure that any updates coming through from the handbook, you sort of check them against your sort of current financial and governance procedures, and make sure that those are still appropriate and in line, or whether you need to make any updates, and obviously then make your staff aware of what those updates are, so that you are compliant with those changes, right from the outset of when they come into force at 1st of September each year. It is the accounting officer who signs up to the statement of regularity, propriety and compliance in the accounts. So they're either stating that there are no issues, or if there are any reportable matters, then these do need to be referred to and included, and you also need to include the relevant monetary amounts where those are known. And then in terms of the audit requirement, as we saw earlier, that's to provide limited assurance on that statement by the accounting officer. So in order to be able to do this, auditors will need to gain an understanding of your controls as an academy trust and carry out relevant checks on those controls. They will need to review relevant transactions. They'll need to look at supporting evidence and so on. And the way that we do this at Buzzacott is by asking the academy trust to complete a regularity self-assessment checklist. So I've included some extracts of this on my next slide, but you should also have a copy of the full checklist, again, in the pre-webinar resource pack. So really the rationale behind asking Academy Trust to sort of complete this checklist as a sort of a self-assessment, really, obviously for us, it helps sort of facilitate the audit work, but it's also quite key in that it does serve as supporting evidence for that accounting officer's statement in the accounts. And even though it is the accounting officer that will be signing off on regularity, in most cases, a trust, we'd probably see the accounting officer being assisted in completing the checklist by the CFO, maybe clerk or governance professional as well within the trust. So as you can see, the form includes various questions on each area, and then it includes a space for the Academy Trust to include their response, and then also a link to sort of any relevant supporting information. And as I said, this will then form the basis for our review as auditors and the sort of detailed follow-on testing that we would do. So just looking at sort of one example there, the remuneration on the screen. So remuneration of employees example, there are questions here about ensuring that the pay is agreed at the appropriate rates. So therefore that's looking at the value for money sort of aspect of regularity. Also ensuring that controls over amendments of payroll are working effectively. And then there's also suggested supporting information and documentation that the trust might want to sort of refer to or include in their self-assessment checklist. So that might be things like, you know, attach your remuneration policy or your agreed pay scales, that sort of thing. And then moving on to my next slide, this is actually my final slide on regularity. So you are probably aware that the ESFA have said that this year they're not going to publish an updated COVID supplementary bulletin again. However, the 2021 version does still remain in force and should be followed where necessary. So for the financial statements, this might have impact maybe with regards to catch-up funding, disclosures and so on. For the regularity aspect, the focus was really around ongoing value for money, retaining value for money. So that does still apply where appropriate. Fraud. Fraud is always a key part of the regularity audit process. Again, we've shared in advance a copy of our fraud questionnaire, and this is to be completed as part of the audit preparation. And the reason I've included it specifically on this slide is that we are seeing an increase in attempted fraud across the sector, as well as cyber security attacks. So perhaps taking advantage of changes in processes with a sort of move to more hybrid working in some organisations. So I think it is important to sort of remain alert, making sure that processes and controls that you have in place are followed in all instances, but also providing that sort of ongoing training and an ongoing reminder to staff. On to my next slide. And here we're just looking at a going concern, which obviously is within the scope of the audit. So trustees should be preparing the accounts, the financial statements on the going concern basis, unless the Academy Trust is winding up or has no other alternative but to wind up. And in order to be able to reach a conclusion on going concern, the trustees need to be able to look at supporting evidence, things like budgets, cash flow forecasts, for a period ahead of no less than 12 months from when the accounts are approved. So this is really December 2023 at the least for the August 22 financial statements. So the conclusion, ongoing concern, the basis for reaching that conclusion, that all needs to be disclosed in the trustees report and also in the accounting policies. And in the current economic environment with sort of rising energy prices and cost of living, there could, I suppose, potentially be some greater uncertainty underpinning some of those assumptions that you're using in sort of budgets and financial forecasts. If you haven't seen it already, the ESFA's Good Practice Guide on operating academy trusts as a going concern is a good reference point and a good starting point for looking at this as part of your year end. You might recall with regards to the audit side of things that the auditor's responsibilities around going concern changed last year. So this was following a revision to the auditing standards, which meant was additional work was required by auditors on going concern. There's been no change this year, but obviously these enhanced audit requirements do remain in place for the sort of 21-22 year-end audits. So I've provided, just as a reminder, a bit more detail on my next slide of what these audit requirements are. So auditors now have to give a positive opinion in the audit report on going concern, or they would need to flag any material uncertainties if that was the case. And as I said, this has led to increased audit work by auditors to really challenge trustees and management's assessment of going concern, really test the sort of adequacy of that supporting information and evidence that's been provided, evaluate the risk of management bias, really challenge those assumptions that you've used. So key documents that will enable us to be able to do this and that we will request as part of the audit will be things like budgets and forecasts, so including cash flow forecasts, which cover that going concern period of 12 months. So, you know, the BFR that you submit to the ESFA, for example. I think it's also important to have a summary paper which really sets out the Academy Trust's assessment of going concern and the basis for that, and that this should be formally reviewed by a finance or audit committee, and that will really help demonstrate that the trustees have adequately thought about it and are really comfortable with that going concern basis. And then as part of the audit, auditors will be looking at your sort of latest financial information available, things like your latest management accounts, right up to the point of finalising the audit report. Sure that your actual performance to date, I suppose, is in line with those forecasts and those budgets that have been reviewed. And then if we move on to my final slide, it sort of follows on from this because it's looking at reserves and I suppose what the sort of, you know, financial health of the Academy Trust is. So as you are aware, each Academy Trust should set an appropriate reserves policy. This needs to be disclosed in the accounts. It could be set as a monetary amount or a range, risk-based, really depending what is most appropriate for the Academy. You then need to also work out what your level of free reserves is at the year end, and you compare that against your required policy levels. So if your actual reserves are below that policy level, you would explain what plans you have as a trust to sort of address this and sort of build back reserves in the short, medium term. And if your reserves are over that policy level, then you would sort of set out your plans for using these. And as we'll see, this is actually quite important at the moment. The slide really is just showing that sort of free reserves calculation. So this is based on Charity SORP guidance. In the case of an Academy Trust, reserves are sort of usually understood to be the unrestricted fund plus any ESFA funding carried forward. So you would exclude the tangible fixed asset fund and the pension deficit from that calculation. There was an ESFA report which looked at the 2020-21 accounts and found that average reserves across the sector were 12.9% of income. Obviously, this will vary across different trusts, but I'm sure that you are aware of that NAO review, which found that a number of trusts had built up substantial reserves, and you may have seen that the BFR now does ask follow-up questions if your reserves are in excess of 20% of income as a trust. So I think going back to what I was saying earlier, this really just highlights the importance of having an appropriate reserves policy, but also really those clear disclosures around this. And if you are holding reserves that are in excess of your policy, sort of really explaining the reason for that and the plans for those. If you've not seen it already, I would recommend that you review Buzzacott's reserves policy guidance, which can be helpful as a guide and also as a discussion document, maybe for your finance or audit committee when considering this. And that's everything I wanted to cover as part of the audit requirements and preparation for the year end. And I will just hand back to Hugh for the conclusion and wrap up.
Thank you, Catherine. So that's just about everything for today's webinar. So we haven't got any sort of burning questions to cover off right now, but if you do have any final questions, please do put them in the chat and we'll do a written response afterwards. Or if anything occurs afterwards, do just get in touch with your usual Buzzacott contact. So just a reminder, we will be sending around slides and the recording after this webinar. But now I'll draw it to a close. So thank you very much for everyone for attending, and enjoy the rest of your day. Thank you.